Okay, so we're good. We're recording now. So just so if you do come off mute and talk, just know you are being recorded. I'm going to post this for everybody who couldn't make it right now to YouTube following this. But I'm glad that we have a bunch of questions tonight because that really makes my life a lot easier when I try and figure out what I want to talk about specifically and not make it all about charts and stuff because, we can do that all the time. And obviously the mission of this group is for you guys to be able to really do it yourselves. And it's really nice to see how there have been a lot of people who are really taking complete ownership of it and doing it themselves. We had another person today pass an $100,000 evaluation account, so that's great. We're over 10, and not everybody here trades futures, so that's really cool to see. And that's without one alert, one anything. I don't know how much experience everyone has had, but I know there's a few people who just really did not do much trading prior to entry here, and they're on their way now. So, step one out of the way now, obviously, to get that payout. That's the next step. But so I just looked, and I have like 22 messages on Discord, and those are all questions. So I want to make sure that I get to all of them, and I'll try to be as thorough as possible without overwhelming. See, the one thing that's difficult is like, when somebody will be like, oh, like, when you say imbalance, what does that mean? Like, I have a lot of the videos for those just so, you can watch them at your own pace and kind of knock it out so that when we do talk about, actual price action that had occurred throughout the day or maybe as it's going on, it's not so much of a learn on the run type experience where if you have that background knowledge, it's really helpful, and it'll kind of bring you up to speed much faster. And the thing is, like, as much as I explain it, really all I'm going to do is just reiterate what I was talking about in those videos that I made. I tried to go as entry level and basic as possible with those. And I know last night's live, we had a few people, they were like, yo, where do I begin? I popped into the live and I was like, whoa, okay, I need to do some. So obviously I sent the syllabus and just things in there that I think are really helpful. We have an onboarding that's great for anybody who just wants to kind of get up to speed. We have the imbalance video, we have the liquidity video, we have the market structure video, and then ultimately all of those tied together, we have my trading model. And then other than that, that's really it. I do have a video on how I map, or I guess formulate trade ideas. I know we talked about higher time frame bias last night, and I do have other videos of that as well. So there's a lot of stuff in the past that I think if you just sit down and watch them for a little bit, it'll really bring you up to speed with what we got, so that when we do talk about current PA, it's not like a mystery or you're not really playing too much catch up. Hold on one sec. So with that, all of that being said, let's get into the first one. So let's see. So SJ, okay. My question for you would be, how would you mark the SoFi daily chart and maybe ride if you have time? I see the imbalances in there, but not exactly sure how you would go about playing those names. Been busy at work, so okay, cool. All right, so let's just look. The first one was SoFi, and this is not really going to be like a chart request thing, but I guess just a way to how I'm mapping it. That's the way I took that question. So if we were to look at SoFi here, right? So first and foremost, identify your pools of liquidity. So what are your pools of liquidity? Whatever time frame you're on. This can be on a 15-minute chart. This can be on a 5-minute chart. This can be on anything, you name it. We want to mark out potential areas, or what is our potential draw on liquidity, aka money. Where are there pools of money that the market is likely to go and snag? So there's our swing high, there's our swing low. We do have some internal range liquidity. Okay, so this would be your range, right? Why? And I'm going to draw it. So why would I draw it in a bullish point of view from our low to our high? Well, if we look at it from this range perspective, what on this run did we take out a high or low? We took out highs right here, right? And with that would be your bullish market structure shift, okay? Obviously, as we come back down into discount, we start to make our move. What do we run into? A daily bearish volume imbalance, okay? That knocks us down, okay? From this point, we'll chop around just a little bit more, get up into this bearish order block one more time prior to releasing lower. You're going to notice that on this daily chart, we have that imbalance that we just filled. We have one more down here, okay? There are a bunch of daily imbalances in here, right? But ultimately, our structure is bullish. So to me, or what I'm anticipating would be for ultimately higher prices at some point. Now you'll notice that this chart dates all the way back to November of 2023, and we've been within that same range, okay? We can even expand it out farther, okay? And again, what was the price run that took out a recent high or low? Right here, bang. Okay, we took out numerous highs with what price run? Ready? I just want to confirm that I'm not, this is discounted right there, okay? This goes to mapping the range, okay? I can't use that because we did get a discount retracement prior to a run higher. So let's just see our next one. Okay, discount retracement, run higher. Okay, there's that. Discount retracement, bullish imbalance, run higher. Okay, so that's why sometimes you'll see it and you'll be like, oh, why would you use that low and why not the other one? This is why. So ready, there it is. So this is our range, right? That overarches our additional range. And how can you see this more clearly so it's not all jumbled and gross? If you just were to zoom out and go to like a weekly chart. Ready? Right here. Okay, low to high, discount retracement. Okay, now what? Waiting for a run for highs here. Okay, but if we were to look at it from this perspective, we have one imbalance left. Okay, on the daily time frame within this current little bullish run up that we've had. Okay, didn't quite take out our high up here to complete our weekly model, but at this point, besides the little intermediate stuff that we have internally of this current range, there's not much. So above that 1049, and I'm expecting that to happen really quickly, knowing that we don't have anything else. Bearish order block, that's about it. But we got into it already. We already took care of some business up there. But just as a, I guess, how can I expand on this really, and just how I can use another example to kind of aid in the understanding of this, right? If we're looking for the market to fill imbalances, okay, I just want, again, this is our last one that technically we gapped up and we did get back down into it. So, we've had price action occur inside this, okay? This one, we did not, okay? And let's zoom in just so I can show you. If you look right there, you'll notice no wicks on either side of that. So this range until now, right, was never touched, okay? This was, okay? We gapped up, but price did leg back down into it. To me, it's still an imbalance, but price has gone into it, no close below. It would be a valid level for me. But here's the thing. Here's just an example of, a name that was very similar to this. And, I noticed this, and look, we got really deep into discount on Tesla, but guess what? This was the final imbalance that we had on this daily chart in this bullish range that we set. This dates back all the way to May of last year, or April of last year even, right? So you'll look, every single one of the imbalances to the upside, right, in this entirety of the range has been filled at this point. Okay, and here's how the last one looked, and look at the reaction so far off of that. We gap up, right? Very strong. Okay, so while Tesla has been getting smacked around for a while, we were still within a bullish trend. Okay, we got very, very deep into discount. Okay, about $8 from kicking the can here, but every imbalance has been filled to the downside, and now kind of wait for a reaction. And here's what it looks like on the weekly chart. Very similarly, deep discount. Okay, let me just add this in because that is a bearish fair value gap right there on the weekly. So it's got its work cut out for it. Don't get it twisted. There's multiple imbalances above, but if we're looking at it from a bullish perspective, right, ultimately, where does a bullish model complete? And that's at buy-side liquidity. So how long is this going to take? Who the hell knows? It could take a while, but ultimately, this specific range gets completed from my model at 299.29. So that's what I'm thinking. Very similarly, again, back to SoFi, where you literally have one imbalance left that really never came back down towards, but price has already been traded inside that gap. So does it have to necessarily? Maybe, maybe not. But the way you can look at this from, I guess, just a broader lens is, at what point do we think that the trade has the potential of going bad, right? And for every single one of these, if you wanted to, you can look at it just from the imbalance itself, right? Let's say you want to add off of the imbalance, right? And use that as your trade idea, okay? Wherever it is inside this imbalance, that could be your entry point, right? Your exit could be below the low of the candle that created the imbalance, which right here, is that relative? No, it's not. Yeah, we didn't take it out, okay? And that would be your stop loss, and then ultimately you would have a target. So it, depending on, let's say you bought a year out in contracts, right? You have the wiggle room and the ability to be looking for a much larger move as a result of that, right? SoFi has been inside a 4-point range for, what is November, like 5 months, right? So buying $15 calls might not be the best idea as a result of that, right? We've been stuck for a long, long time. We can still have that bullish bias looking for higher prices, but ultimately, in the meantime, this could take a while. So how is that tradable? Trading weekly contracts on that might not be, the best in this situation. You know what I mean? As a result of that, because we've been trading within a $4 range for how long? 5 months. Is this the week that it takes off and it blows off the top? It could be, but guess what? If it's not, your weekly contracts are probably going to get wrecked if you're going far out of the money. Okay, so I hope that helped a little bit. And then Riot was the second one. We can look at that too. But okay, so Riot on the daily perspective. Okay, you have relative equal highs up here, there. Okay, let me just pull up the weekly chart. I can't look at it daily without getting an overarching bias. Yeah, so this is where things got a little hazy. So while Mara, to me, looks bullish, and I'll show you that in a second, you have something like Riot, which, in all honesty, to me, it really doesn't. But here's the thing. Just because it doesn't look bullish at this moment doesn't necessarily mean that you're not going to shift market structure, right? That is a possibility, and that's something that will happen. What is oftentimes the market tipping its hat to you that there could be a shift in market structure, and it's something as simple as low, high, lower low. Okay, the high of that sequence, we would view that as our bullish breaker. Okay, there it is. So when price runs up through, we would anticipate the high candle of that sequence acting as a support level moving forward. There's one, there's another, there's another. So that would be the bullish breaker in this situation. Are we going to shift market structure as a result of that? Could be. Just from me looking at it here on the weekly, I don't really see anything that I would personally be looking to scoop. Ideally this week, you get an up close back inside this imbalance, but and really at this point it would look something like this. Hold on. Whoops. Okay. So if you were looking at it, I don't know, prior to last week, right? And you say to yourself, okay, I'm adding off of this daily imbalance. My stop loss is below the low of the candle that created the imbalance, and I'm looking for buy side liquidity, relative equal highs up here, right? That's your trade map. Did you get dangerously close to taking out that low? Yeah, absolutely. But that trade itself is not void yet. Honestly, not the most ideal setup, but if that's what you use at the criteria for your trade, it's still intact because our stop loss wouldn't be triggered just yet, right? So who knows? Maybe this week we paint a bullish order block, crypto names start flying again, and we go and get those equal highs. But that's the thing. And really the reason why I wouldn't even consider something like Riot is just based on, I would just prefer it to actually be in a bullish structure, right? If our overarching range is bearish, I don't really want it all that much, right? And again, the difference here, you can look over at from this perspective here, obviously a massive run up a couple years ago, but really, really close to the lows that it made down in Pennyland. So just not really ideal for me for those reasons, but that would be how I'm kind of examining Riot. I mean, we look at it here. Here's your bullish imbalance on the daily time frame. I know this is going to look ugly, but because it's a daily chart, but there it is. So on either side of that candle, you have no wick, okay, and you have a gap up above it, okay. So your fair value gap would look something like that, and you would have a bullish volume imbalance above here, just like that, okay. Relative equal highs above, and deep discount, but not quite donezo yet. Okay, so that's where you're sitting at. All the imbalances down below have been filled. So even if you look at it from this perspective, under 1025, I'm donezo. And you know what would be the target in this situation? You can look towards buy side liquidity, relative equal highs up here at 1836, right? So that would just be how I would use the daily time frame to kind of work out those kinks. So that would be question number one. So hopefully that was helpful. And if you have any questions off of that, feel free to pop in.
Mando, can you hear me?
Yeah. What's up, man?
I was just gonna say too, like if you look at Mara and Riot, like they're both doing, they're both crypto blockchain name, and if you look at Mara, like Mara's, arguably in a 10 to 12 point range. Riot is in a much less range. Like I rather
True.
play the name with a much higher upside.
Yeah, no, that's also very true. I think ours, the idea for Riot in that point was like, well, not really an idea, but just I guess to map it out. It was like potentially 8 points while risking one, and on Mara here you got 4 for a potential, to me 16. So, whatever. I guess it's mathematically the same, but Mara just tends to move better, and to me it looks much more bullish on a little higher time frame scale. So
remember when Riot led last year, and it was like ahead of everyone, and then
Riot led for a long time.
Dude,
and that
Riot was at 94 and Mara was at like 60.
yeah. I just want to say, I mean, people can lawn this. I have no problem with it, but I just don't see any big significant upside unless they execute well. Like I know fundamental, but I mean, if Bitcoin goes up, miners will get bid, no doubt. But Riot has just been underperforming for so long over the last year. They had such high expectations that the market's just not giving them the love that they should get, So
Yeah, no, there was a flip for a long time. Riot's price was always higher than Mara, and then it's I guess over time differences in companies will weed each other out, um, but yeah. So I know that was long-winded for one question, but I'm gonna just keep on running through. So here's my question. Do you have a new week open gap charting example in the syllabus? I need to review this concept and prefer your explanations to ICTs. Okay, so here's the thing. There's a lot of ICT concepts that I personally just don't feel the need on making a video for. And here's my reason. Does he have a video? Yeah. But at the same time, he has 1 million subscribers and he's banking off of making those videos and, earning based on your watch hours, right? To me, the new week open gap can be explained in maybe 3 minutes. So for me to make a video on that, I just don't know how, beneficial it would be. But simply put, all you need to do if you're a futures trader, and the way you can view the new week open gap is it's really just you're either going to see it act as a support, you're going to see it act as a resistance, okay? And for whatever reason, that level is strong. So for example, last night we gapped up, price retraced back down into this new week open gap, and look what happened. We took off, okay? So this week's new week open gap thus far has acted as a support level, meaning that our weekly candle, or that's monthly, sorry, our weekly candle is painting green at the moment, right? That's from start to where we are now. Okay, so that's the way we can use the new week open gap as a, I know it sounds so simple and stupid, but it's an additional level that to me is excellent. And if you just look at it from this perspective, what else was this? It's a volume imbalance, right? But you will notice that while a volume imbalance might fill, right? Like we filled that volume imbalance. One thing that he spoke on was about keeping previous new week open gaps on, and I think it's for 2 months. So I have the last 8 new week open gaps mapped, and sometimes, for a long time, the way we were operating and when we were just continuously moving higher, we were not coming back down to any of these new week open gaps. So it was really just a concept that was you know, irrelevant. Really, we were just blowing off the top. So we weren't coming back down for those previous new week open gaps. Now we have a few overhead. So, to me, I think it's just nice to have them on the chart. It really not much else other than that. If you're below it, you can anticipate that acting as a resistance level. If you're above it, you can anticipate that acting as a support level. And that, again, it's just something as simple as that. It's not all that convoluted or anything like that. Now, on top of that, there's so many different stuff that we talk about in here, right? Whether it's new week open gap, whether it's breakers, whether it's fair value gaps, whether it's liquidity, whether it's market structure, whether it's order blocks, whether it's you name it. There's hundreds of things that we do talk about in here. But remember, you don't need to use all of that, right? For example, if I'm using just my model, which I do take, almost all of my trades based off of that one specific model, all you really need at that point is, I guess, you have to be able to evaluate a higher time, which we kind of spoke on last night, on just how to create some sort of bias moving forward. Second, how to map a range and understanding your current market structure. Are we in a bullish trend? Are we in a bearish trend? Then you look towards liquidity, buy side or sell side liquidity. What is our draw on liquidity? Again, that kind of goes back to your higher time frame bias. And then just the ability to map imbalances and look for them in discount. So, again, there's so many concepts. There's so many different ways to do it. Let's say, for example, KD, he likes to play, I don't know. Let's say he likes to play the breaker strategy, right? So he might have his own model strategically based on breakers. So he doesn't enter anything until he sees the breaker confirm itself, and he will enter off of that, anticipating that candle acting as support and moving forward. Or vice versa. If you have a bearish breaker, he's anticipating that act as a resistance level, and that trade is mapped out. Because to me, the most important part about all of this, and this is why I think having some sort of strategy or model is so important, is because that in itself is your way of being able to map out your trade idea, right? It's as simple as that, right? If we're looking at a, I don't know, I'm going to cherry pick something. Let's go back in time. I have it here on the weekly. So if we were just to look, from a weekly perspective here, and this is dating back all the way to COVID lows, but let's just pretend this is a 5-minute chart. Okay, let's just pretend, just for shits and gigs, right? Okay, so we took out this high here with what price run? This low to that high. Okay, you can go to every single one of these red candles. I have them in black, but go to every single one and make sure price doesn't retrace to discount. Okay, simply put, when price retraces back down into discount, right? And there's oftentimes you're going to get there could be a few of them, right? And obviously right now, because of the range, it's very large, but you can literally use these imbalances as your trade map, right? So if you're entering off of this imbalance, looking for that turtle soup right there, then you could say to yourself, okay, I want highs off of this. My stop loss will be below the low of the candle that created the imbalance higher, and so be it. And even if you miss this, okay, right when you see your next range getting set, okay, we took out that high here with what price run? That right there, okay, and then from this point on, whoops, okay, we get our discount retracement. We're in a bullish imbalance. And then there's your run for highs, right? So it's very, very repeatable. It's something that happens every day. I bet you if we just go through 5 charts right now, maybe at the end, if these questions don't take all that long, we can go through 5 charts. It doesn't matter. I bet you we can find 5 examples of where this model has worked today. It's repeatable. It's something that I think, to me, is very easy to understand. But the one missing caveat that I think, comes into play quite often is just your higher time frame. Like, does your higher time frame correlate with your current idea? If you're bearish on your higher time frame, you could think we're going to bounce and everything like that, but you just have to have go into it with the understanding that this move might not be as fluid or sustainable, because I am technically, quote unquote, fighting a trend, right? You're fighting your overarching draw on liquidity, where price is ultimately going to go. So it's much harder to justify, or I guess it's much easier to justify a loss because you're technically fighting the trend. But when you're going with the trend, to me, it's harder to justify against that trade idea. So that way, you feel pretty good about it when you take it. And that's kind of the way I look at it. I don't really want to, there are certain situations today, even in today's PA, where I was just like, I can kind of see it shaking out either way. Like, I'm good, and I just didn't do anything. I think that's empowering, and I think that is probably the if we're talking about, like, there's levels to this. So obviously having the concepts down, all that is great, and having some sort of game plan and the ability to understand how to make that game plan. But if you're just to kind of go back in time, and think about, okay, let's say I got that down. Now what, right? You still have to execute, and execution to me is going to be hard regardless. You're going to fail, and if you don't know how to fail, meaning that you can't take a loss or accept that you are wrong in a certain situation, you're going to be in for a long, a hard journey to kind of get through and crack that, because, you know, you're gonna lose. I lose all the time. I'm sure everybody here loses. You gotta have to be a good winner, and by being a good winner, it's understanding, okay, below this low, I'm cutting this trade because blank. We took out the low that created an imbalance. Or B, we shifted market structure. So even if we bounce, it's a little sketchy. I want to take my loss here below the candle that created the imbalance higher, because we can very well get an imbalance to the downside, and this loss can get out of control, right? There's so many little things that move, and that's why, to me, I just placed the order on the screen and it's smooth as can be, because I'm not even thinking about anything other than that. If it hits, I lose. It sucks. Everybody hates to lose, but if you can't and don't know how to lose, it's going to be very difficult for you to kind of overcome that, because I don't really think anybody's going to, like, feel bad for you, maybe your friends and stuff, but this algorithm that's delivering price sure as hell does not feel bad for you. They're not going to throw you a bone here and there. It's just not how it works. Okay, so that's the next one. Let me just go into the comments and see. I heard some dinging, so I want to make sure that I'm not leaving any of this out. Let's see. Okay, I'm just going back to the questions really quick. So let's see, where is it? Okay, so there's a few here that I'm going to go through right now. So okay, main issue is that I'm having a hard time figuring out where to enter, place stop loss, exit based on your model on the smaller time frame. For example, today within Q, my initial idea was to short around 18,215. I mentioned that in the chart from the weekend, but with the steady run up overnight, that went out the window. On my 1 hour chart, I don't see discount until we get below 18. Okay, on the 30-minute chart, I see a discount. Did I do that correctly? Yes. So what do you do on days like this? Just don't trade unless you get a 30-minute discount 1 hour? No. So I use the higher time frame to kind of dictate my ideas on a smaller time frame, right? So let's just go over here to NASDAQ and we'll go through it. But I think you might be overthinking this a little bit, right? So look, ultimately, I would prefer my hourly to suggest, whatever the direction, what it suggests, some direction, right? I don't really care if it's up or down, right? But if our hourly is suggesting some sort of direction, whether, again, that's up or down, it doesn't matter to me. I want to be trading in the same direction as that, right? So for example, if we have a bullish trend on the hourly time frame, I'm going to want to trade in that direction. So I want something to transpire that would, ultimately back that idea. So for example, this is not a trade I took, but if you were to look at this right here and you see, okay, we're moving higher, right? We know that we just took out higher time frame liquidity in those relative equal lows. I'll come over to the daily and show you that. Okay, we took out the relative equal lows. So although we have a new bearish market structure like we do right now, okay, right, taking out that low, that was the run that started, or that was the price run that took out these highs, and by taking that out, we shift market structure. But oftentimes when we take out higher time frame liquidity, what does that do? That'll give us a bounce, right? Two pools of liquidity, right? Those can very easily be used as a way to move price or give us that bounce, right? Which we got today. So if we're using that and we're expecting some sort of bounce like we talked about last night on the session. Now I wasn't so sure we were going to get over this with these, but we did. But by getting over this, and our direction ultimately is bullish at this moment, right? Our expectation would be we can use a in imbalance, right? And this is not a trade idea because I still think we're going lower. So I'm just prefacing this with, let's say, okay, our hourly structure is bullish. Would you agree, disagree? Yeah, I would agree. Okay, we took out this high with that run. Why do I think we're going to go down? Higher time frame trumps all. So if we're looking at it from this bearish point of view, I'm not so sure that this low has enough juice for us to shift market structure. How else? Well, I'm also using ES or SPY in conjunction with my idea on NASDAQ, right? I want to see SPY getting a discount. We haven't been in discount in a long time, right? We're not all that far away. We have the relative equal lows still left on SPY. Now, could I be wrong and we blow the top? For sure. I'm not trying to say that I'm going to be right here. It's not as cut and dry as what it's been over the last 5 months. I'll give you that. But I'm just saying from my perspective, because the daily is a higher time frame, and why would a higher time frame matter any more than a smaller time frame? Think about it like this. Okay, in a day, right, we know that futures trades 23 hours a day. So we have 23 1-hour charts, right? That's giving us much more information, and also it's processing much more orders, right? You're getting much more orders painted and shown to you in a daily chart than what you would get in a hourly, right? It's the only thing that makes sense, right? So I want all of my time frames to click. When all my time frames don't click, to me the trade is going to be much more difficult right off the bat as a result of that, because one, if you're not clicking on all cylinders, your draw on liquidity or where you think price is ultimately going is not going to be clear as day. And I tweeted about this today. I said, when the draw on liquidity is not clear, that's likely because you're going to be it. They're going to come get you, right? It's going to be some choppy garbage price action, and they're looking to gather liquidity for that next move, right? And I don't even know if we have data tomorrow, but on Wednesday we got FOMC, right? So, we do have stuff coming down the pipe, right? So really the way that I look at the days prior to that, if there's no type of data or anything like that, it's just a way to gather liquidity for that next move, right? And that's why, what we've seen over the past, and this is something you can back test as well, when we have data on a Wednesday and no data prior. So this would be like a legit assignment, right? You'd have to go back and really look at this and make sure that all the criteria is met. But if we don't have data on a Monday or Tuesday and we have a big event on Wednesday, like an FOMC minutes, CPI, PPI, whatever, you'll notice that oftentimes those first 2 days you'll get whatever moves, but oftentimes you're going to open up on Wednesday going into that data pretty close to where you started, right? Again, something you can backtest. Don't take my word for it. Look for yourself because you'll be able to find it. Just something that I've seen over a little while of looking at it that way. So, but again, going back to your overall idea on how you should, or what kind of entry model you can have, if you're using my model, then it's something as simple as identifying an imbalance, using that imbalance as your entry. It doesn't have to be the top, doesn't have to be the bottom, doesn't have to be the middle. Where can you pinpoint and be as accurate as possible with this, right? So if you're looking at it as the new week open gap, you say to yourself, okay, I'm going to use the low of the candle that created that imbalance. So on a volume imbalance, I use the previous candle because that's a gap higher, right? So I'm using that as my stop loss. So again, my entry is set, my stop loss is set, and where would my target be? And ultimately on my model, this is a much smaller, more of a scalp type situation, but it'd be something as simple as this. Look, ready? Discount retracement, bullish imbalance, run for highs. That's really it. Okay. From that point, I wait and see. Do we create some sort of imbalance through our target or buy side liquidity? And if that's the case, you can let it run. And there it is. Right. And that's as simple as can be. But for each of these, right, after we take out my high and I let this kind of, hang out for a little bit and see, do we make that imbalance? And if we do, what are my next type of targets? Well, here's one. Whoops, here it is. There's our first. There's our second. Here's our third. And we can just see how price reacts to those levels. That's it, right? So it's not like I'm reinventing the wheel with anything, really. I'm just looking at what is our likely draw on liquidity from each. If we get an imbalance up through to complete my model, I'm expecting price to go higher. If it does not, if we sweep it and pull back. So let me see if I can find an example really quickly of where we sweep it and pull back, like almost immediately. No, not really. Nothing off the top of my head today. It was pretty smooth. But, do you take out whatever your draw on liquidity was? It's simply put a swing high, whatever time frame you're looking at. Do we take it and create an imbalance? Look at this one right here. Okay, see that? Look, imbalance up, suggesting higher prices, right? So, that's it. It's as simple as that. I don't try and overcomplicate things. It's obviously when you're in the trade, and this is probably my biggest fault, but especially since now I typically trade with 2 contracts, but by trading that, sometimes the range is huge and I'm up like a ton of money, like right here, right? And I don't want to see this candle. Maybe this candle's 20 points. I don't want to give back $800 on whatever I just earned, and that's why I'm a little more aggressive with pulling it up, even if it's going to ultimately end up meeting the criteria for a continuation type trade. I don't mess with it too much when I trade with NASDAQ with 2 contracts, because that's potentially giving back a lot of money. I don't want to give back $800 period ever, so that's probably my biggest fault as a trader in itself. It's not so much where to target, where to do this, where to do that. Oftentimes, I'll be wrong, but on the flip side of that, when I'm right, I don't sweat it, because I feel very strongly that price is going to go to our draw on liquidity, which is here. But I still have to actively manage that, because money's not fake. This is real. I would prefer to take $800 than give it back. And that's why I'm fairly aggressive with how I'm moving my stop loss. And at the end of the day, I don't care as much. I'll take the money. Some people might say, "Oh yeah, if you're that good and you know where price is going, you wouldn't move your stop loss or anything like that." To me, I would much rather just protect it, take my win, and not play games, silly games, which I think that is. But that's just kind of my opinion on that. So that kind of goes to the entry, exit, and how I'm placing my stop to in order to protect myself. But let me go to the next one. My question is, how do I take the higher time frame bias and structure a lower time frame trade up step by step? I'm looking for a mechanical way to come up with the trade plan. And another related question is coming into the session today. The hourly structure was obviously bullish. Did it change bearish once the NQ puts in a low on the hourly time frame and takes out that swing low? And until that happens, do you just have to stay away from shorts? So again, what is your higher time frame telling you? Right now, to me, the weekly's not giving us all that much. Okay, I think on the monthly on NASDAQ there's a couple bullish imbalances much lower, but those aren't really viable for us right now. The weekly chart, I don't have any imbalances, really not much going on here. And then if you go to the daily time frame, we did just shift market structure bearish on the daily. Okay, so the only caveat to that is the other index that I use as a pair to kind of help clear things up that might not be all that clear. Both of them, dollar to me doesn't look all that great, and ES has a massive range, and we have not gotten into discount yet. So could that change up as a result of that? Yeah, I think it could. But in the meantime, I'm not going to be playing with fire all that much as a result of that. But currently, we got up into a discount bearish imbalance, and so far we've rejected. Do we come back now for that 18,006 and complete my model to the downside on the daily time frame? Possible. But if my daily is bearish and we're bullish on an hourly time frame, I have to know, okay, let me go back over to the daily and see that we have a bearish level in discount here, and this is where I proceed with caution, right? I would really be proceeding with caution here as a result of that, because we technically have not closed above that imbalance to negate it or to balance that specific price range, right? And let's see. Oh, and this was just a optical thing. Okay, so I'll get to that. So there's a few questions here that I think I can easily answer on the chart, which is good. So I'll get through those. Now let me go back to the chat and see if anybody had any additions to what we were just saying there. Okay, I don't see any questions. If you did post a question, definitely. Oh, I do see one. Okay. Could you explain the importance of 8:30, 9:30? Yeah, so 8:30 would be your, typically a data candle on days where you have that pre-market data. You'll notice, you know, there's a good chance that when price gets up into that level, you will see some sort of reaction. Now, does that mean that it's going to be a perfect support or perfect resistance? No, but to me, it is just something worth noting because for whatever reason, whether that's a time that I don't know, maybe like a clearinghouse or something kicks in. I think it's more something that you just have to kind of throw on and see how it interacts with specific levels itself. But that would be, that. And right now, mine aren't even calibrated. I have it. I haven't even changed it from. It should be -4 because we're in what's it called? Daylight savings or whatever it is. So here's your 1:30 candle. That's your 1:30 time. You just see how it kind of reacts here, right? So if you're looking at a 15-minute, you don't really have all that much info, but we did get back up to 1:30 and rejected that. So, and then obviously 9:30 is when equities open. Midnight, that's another level you can look towards. What else is another one? 1:30. I use 1:30 as well. That's like the start of the second session of the day, essentially, right? Where you have your morning session until about 12 o'clock. Then you have your lunch hour where you don't typically get all that good of PA. But then 1:30, you're leading into that 2 p.m. silver bullet, going into the afternoon and close. So, that's kind of just a way to segment your day. But it is interesting to see how price reacts to certain levels, just based on time. That's a huge thing for him. I think the time part of it is less about, these 8:30, 9:30, midnight, 1:30, whatever it is. And for me, particularly, it's more like, okay, my model is setting up, but it's 11:48 on a day where we have no data. I might not take that. I think we're just going to chop around. It's probably going to be a headache of a trade. And I'll deter myself from taking that as a result. That's kind of the way that I look at time, in addition to just these specific ones right here. So let's see. Let's go back in here and just check it out. Were there any more? Okay, nah. Okay, so let's go back over here, and I have more that I want to get to. All right, we're already 42 minutes in, so this video is going to be dumb long, but let's see. Okay.
When you get a chance, Mando, can you check out copper?
Yeah. So Tesla, I've had success with it, but I paper handed quite often, trying to get better with letting a winning trade. Any suggestions are greatly appreciated. Okay, so I mean, if you're, it's not a bad thing to be winning on something and being a paper hand. I think it's always going to be hard to not be a paper hand, right? Especially when you make a substantial amount of money, yada yada yada, all that good stuff. But if we're looking at it today, just from an hourly perspective, right? So when you get something like this, okay, right here, this is something that I like to see personally, and I'll explain to you why. So when we get a specific run, right, and in this situation here, not only do we have a bullish breaker, low, high, lower low, and a break of that high, so we can use this candle here as a breaker, okay? Once we broke above it, price respects, takes off, okay? I'm not saying that's really the idea there, but when you see something like this occur, okay, where you get that nasty candle, you just have to look to your left and say, what was the draw? What was my draw on liquidity there? What was my target in this specific instance, right? And you say, okay, well, it was 171.17. Okay, now you got to ask yourself, why did we stop here, right? I don't see any higher time frame imbalance in the mix here. And what is this also showing you from this perspective? It's relative equal highs. What do we know about relative equal highs? Oftentimes price does like to go back up and get them, right? And then this ultimately would just be an explanation of that, right? We dip deeper into technically our discount of our specific range, which I just want to see just to confirm. No, we didn't even get into it. So this is just be an opportunity I missed. But ultimately, knowing that you have those relative equal highs above, that would still be your draw on liquidity in that situation, right? And you got another situation like that up here, right? Relative equal highs. Okay, sounds good. Satisfied all of our daily imbalances. Okay, and this is again, you might be on here right now and saying there's no way I can cycle through all these different time frames and do all this. It's really not. Once you kind of get used to doing it, I'm telling you, it's not as difficult as you might think. Map them out, chart them. It'll take you an hour on the weekend. Do just a couple names. You don't have to do all of them like I do. I'm an idiot. I shouldn't do all of them. But just map out a few and just, you'll be able to scan it through real quick. All right, well, the weekly on Tesla, we're really deep in a discount right now. Even below our current low, we do have a bullish imbalance down here that we didn't completely fill. Okay, that's good. Now let me come on over here and take a look at the daily. Oh, well, I'm looking on the daily right now, and I see that every single one of these imbalances here have been filled. Okay, so that's pretty encouraging. This gap up, that's also very encouraging. Now creating this bullish volume imbalance on the daily time frame. Right, okay, good. Now what else can we look towards? Well, we can see low, high, lower, low. Okay, a break above 205.60 and we create a bullish breaker. All right, cool, that's good. I can throw that in the bank. I know it's far away, but at least I'm seeing that in advance, right? We want to anticipate. We don't want to react, because when you react, you're late, and oftentimes that'll create some sort of emotional trade, or your entry is going to be garbage. So when price does retrace on you, which seems like it's going to automatically happen, right away every time you enter something, when you're not using some sort of structure to enter off of it, you're like, oh, of course it went down right away, right? It always feels that way. So you're going to be down and you're going to be fighting for green. So just for you to fight for green, you don't have the patience or the discipline to kind of just sit in that thing and wait for it to kind of take off and do its thing. And then you're fighting for green, you make a couple bucks and you get out of it because of that. And ultimately that was the setup for your ultimate trade that you wanted to take in the first place, and you missed it because your entry was poor or something like that. So again, going through multiple different time frames, to me, it's a good thing, and it's just kind of a way that you can map out everything on how you think things are going to shake out using weekly. Okay, I have my idea here. Now let's go to the daily. Okay, that checks out. That's good. All right, now I kind of have an idea of what I want to see going forward. Good. Hourly here. Okay, good. All right, now I'm all mapped out. I have a good idea of where I think price is going to go, and if I get, let's say I'm bullish on Tesla, okay, I have a bullish game plan here. If I look at it from this perspective, here's the price run. Again, this did not get into discount, so this is my current price run. Beautiful. Okay, so I don't necessarily know this is going to be the range setter, right? I don't see any imbalances to the downside here. But if I get an opportunity down here, I'll feel pretty good about taking it, because I know this is in discount. I know my whole trade can be mapped prior to me even entering, okay? Look, I have I have this imbalance right here. I can use this in itself as my entire trade. So I would enter off of that 165 or 165.62, looking for 174 ultimately to complete the model. I know my stop loss has got to be below the candle that created that imbalance. And in a instance where you have a volume imbalance, I'm going to put it right below the low right there, 163.81. Great. Okay, look, I'm all mapped out. I'm good to go. Okay, on to the next one. Bang. And then you can kind of move it over that way. But when you see those relative equal highs like that, a lot of the time, they're kind of like playing you a little bit. It feels like they're just not going to give it to you all that easy. You're going to see things get smoked, and you're going to say, oh man, now I'm bag holding this, that. But again, buying time on the contracts helps. Knowing where your draw on liquidity is, right, where you ultimately think price is going to go and why, right? Oftentimes when you can kind of formulate that yourself, what's your draw on liquidity and why do you think it's going there, right? Maybe it's based on your current market structure. Maybe we got into a discount imbalance. Maybe we swept higher time frame liquidity and you're thinking it's time for a reversal, right? All of those little things can play a factor, but when you can create that for yourself, you're going to feel confident in it when it shows you that it works, right? These concepts do work. I wouldn't post, success stories about them if they didn't, or I wouldn't, show them to other people or talk about them if they were just ineffective and they didn't prove that they do work. So I guess that's kind of where you're at with paper handing. Also, you're probably going to feel like you're going to paper hand if you're over leveraged. So if you have too much money in a play, you're probably going to want to just take profits on it at a good time. All right, for example, I don't think I'm over leveraged by trading NASDAQ. I think it is just an extremely leveraged vehicle, and that's why I gotta take profits and I gotta protect myself, because those big fluctuations, even like I said, it was before, it was like, let's say it was $800, right? That sucks regardless. I don't care how much money you have. $800 still sucks when you're trading two contracts, because it is a substantial amount of downside, and that's why I would prefer to cut that out, because I don't even want that negativity, that negative mentality. Oh man, I could have had this and now I don't. Now I got to go push some buttons that I probably shouldn't have done in the first place, and now I'm red on the day or some stupid thing like that, right? I try to completely avoid that. And something I think I've gotten the best at, really, is that when I go green early in the day, I do not go red to close the day. Rarely ever at this point. I just don't allow it to happen. And for better or for worse, maybe there are opportunities that I miss out on because I'm that much more particular after I make some good money in the morning or something like that. But I really tend to avoid even putting that up for consideration. If I'm green, good green, I'm not talking $20, I'm not talking $100, I'm not talking $200. If I'm green, $800, $1,000, there is zero chance I'm allowing myself to go red at this point. Zero. I've been there. Trust me, it's happened to me before, especially when I was doing stupid stuff with SPX. I would crank one in the morning, make a couple grand, and then later in the afternoon, it's magically all gone, or I'm red at this point. You know what I mean? That cannot happen, because that emotional roller coaster that you're going to put yourself on is not ideal at all. It sticks with you. It carries. It's very, very hard to crack. And then at that point, you're probably better off just paper trading for a while and getting yourself back on the right track, because it can take a while and it can kind of stick with you in your future trades, right? It's easy to say, oh, I'm going to flush it and I'm going to move on. Everybody says that. No, not everybody can do that. It's not easy, right? And that's why I feel like I'm a robot, because I put the trade on the screen and that's it. I don't think too much about it other than that, right? Entry off the fair value gap, stop loss, okay, below the low that created the imbalance, or if it's bearish, right, above the high of the candle that created the imbalance, right, same thing, just flip it upside down and target, whether it's a bearish structure, I'm targeting swing low. If it's a bullish structure, I'm targeting swing high, right? And that's it. Just keep it as simple as possible and try and take as much thinking and human intervention out of it as possible. So that's that one. Okay, so let's go over here. We got a couple more. I might have to freeze it and then do it again, but okay. After you map the range on the 1 hour chart, do you open a separate chart for, say, the 5 minute and then draw your range out there, determine entry, or do you stay on the 1 hour chart and drill down to the lower time frames and enter off of that? Totally makes sense. So here's what I do, really, and I don't even think I have it on today, actually. Yeah, I haven't even done it. Okay, so here's what I do. I go over here to the hourly time frame, or even this, it's very dependent on what I'm currently seeing. Okay, bing, bing. Okay, so let's just look at it from this perspective. If we look at the 4 hour here, okay, we took out that low right here with what price run? Okay, from here to here. Okay, there it is. Boom, boom. Okay, so that's my hourly. Check this. What do we get into and where do we reject? That's a bearish imbalance in discount of a bearish range. Why wouldn't I use this price run? I already completed my model. There it is. Discount imbalance, check, dumper through the lows. My model's complete. You see what I'm saying? Very repeatable, happens every day. So that was the price run that took out the low, and because of that, that's where we currently sit. But how does that play into the question that was just asked? Simply put, come on over here, and that would be my range. Sometimes you don't even need to do that. Sometimes you say, oh, okay, this was the price run, easy, no brainer, right? Other times it might be a little bit more difficult to see, right? So that's why if you go to a higher time frame, it's just gonna be cleaner. It's gonna be easier for you to identify a range. But yeah, that's that's currently what we got. I have map for my range, but I do flip over. But I also have all these different layouts, and again, it's not like I have all of these levels on one chart, and if they're not on one chart, then that's it. You can have multiple chart layouts, and just keep in mind, just be like, okay, we're going up to the hourly. Even if you want to say, for example, this is not an imbalance on a smaller time frame. You might say to yourself, why the hell are we rejecting here? That's why cycling through time frames is important. So, and again, that can all be mapped out prior, right? If a new one comes, maybe you want to throw it on, but this was here from a couple of days ago, so it's completely justifiable there, so that's how I kind of operate using that. So now let's see here. Can you really go over how you make your risk only be 100 per 200 per trade? I find myself being right most of the time. When I'm wrong, I get smoked because my stop that makes sense is like 400 to 500 bucks away. I have to wait for an imbalance to form, often hourly, and after a 5-minute get formed, obviously ran for some points, and then placing my stop on the top of hourly is typically like 20 or 30 points away. Yeah, so why not use a smaller time frame as your driving factor there? So within this 4-hour bearish imbalance, right, if we were to go to several different time frames, I know that currently the 15-minute doesn't offer you really anything, but if you were to look through multiple different time frames, I bet you can find an imbalance it's much smaller than what your higher time frame imbalance is, and that way you can use that as the map your trade. And look, in a situation where maybe in that 4-hour imbalance you have 2, 3, 4 imbalances within that 4-hour imbalance, right? Is there a possibility that you get stopped out on one of those? Yeah, but your risk is going to be much less as a result of that, right? And here's the bottom line. If you're looking at it and you're saying to yourself, okay, if I'm wrong here, right? You have the imbalance, you got everything mapped out. If that range is too big, you don't have to trade it. No one's forcing you to do anything, right? You do not have to do it. So why? Why are you forcing yourself to do it? It's, you really don't have to. So that's just my way of answering that question. So you just actually answered the question in live. Oh, okay, cool. All right. Let me just go back over here and say, I think this might be all of them. I think I hammered them all out. So let me go back over here to the chat and just make sure that's all. So let's see. When you position your stop loss for a long, do you typically put it right after or right at the low of the candle that created the imbalance, or depending on other factors, will you position it above or below the low of the candle that created the imbalance? It's the candle that created the imbalance. It's not the imbalance itself. Those wicks will give you a heart attack. Bodies of the candle tell you the story. But oftentimes when you do take out the low of the candle that created the imbalance, like we literally just did on futures, oftentimes that means we're going lower. So at that point, I would say, all right, we're probably going here, 139. You know what I'm saying? It's just a way to map it out and to protect yourself. This is something you guys can backtest too. Go and check it out. See how well, price would respect certain imbalances, and even when you get the wicks below them, does it take out the low or the high that started that imbalance? And a lot of the time it does not. So you're welcome. Yeah, I don't know. I don't even know if you can do multiple if you don't pay for TradingView. If not, I would just say you can mark out some swing highs on the higher time frame. Maybe you see a 4-hour imbalance like that, you can say, you know what, I'm going to throw this on the chart, and maybe I'll write in here 4-hour bearish fair value gap, something like that, and then just have it there. So if you don't have access to multiple charts or layouts, you could just do it like that, or maybe color code them. You could do this as your 4-hour. I want to make that my purple or something like that. It's just a way to kind of be neat and organized. I think that's helpful too, because you don't want to just see that and be like, oh, where the hell am I getting that? And you're gonna like flush through multiple different time frames and trying to do it really fast. Yeah, no, it's worth it to me too. Yeah, I just don't want to be all jumbled, but all right, I'm gonna stay on here because I see people typing in the chat. But this is, you know, it allows me to record for an hour, and this is where we stop. So again, hopefully this was helpful. And if you got any more, shoot them out.